everyone, and good morning. What an amazing energy here today. I am so pleased and excited to moderate this wonderful panel today on the topic of Wall Street and Bitcoin. As an introduction, I am Shirish Jajodia. I'm the Vice President of Treasury and Investor Relations at MicroStrategy. I'm a core part of the Bitcoin strategy at MicroStrategy. Previously, I spent over a decade in investment banking and Wall Street. And I'm a Bitcoiner class of 2017. So back in 2017, when I used to talk to my investment banking and Wall Street colleagues about Bitcoin and try to orange pill them, they used to all look at me like I'm totally crazy. And some of them actually still do. But fast forward 6 years, we have come along pretty far in the awareness and maturity of Bitcoin as an asset class. And today, MicroStrategy is the world's largest corporate, publicly listed corporate holder of Bitcoin, holding 140,000 Bitcoins. We are leading the path and paving the way for other corporates and institutions who are looking to adopt Bitcoin as a part of their corporate treasury. But before we dive deeper, we have amazing research analysts here. So Lyn Alden, Andrew Moss, and Mark Palmer, they interact with the retail and institution sides and the corporates on a very regular basis. So for our audience who are relatively new to Bitcoin, we would like to simplify and lay out, like, what's the importance of Bitcoin? So Lyn, would you like to kick us off?
Yeah, sure. So, over the past several decades, there's been a lot of FinTech activity, obviously, a lot of companies spinning up around FinTech. And mostly what they do is they provide overlays on top of the existing financial system. So they're not really changing things from the root layer, but they're making the way that we interface with the financial system a little bit more convenient, faster, making use of software, making use of new technology. And I think what the importance of Bitcoin is basically a computer science breakthrough that changes how we interact with money at the root layer. Basically, it's open source money, it's global money, it's decentralized money in basically a cloud. You can access it around the world, you can send it around the world, and that's a very powerful concept that is very different than decades of basically FinTech innovations. And if we back up further, the way I would put it is that for centuries, most of banking has had two major functions. One is the provision of credit, and the other one is basically about making money faster. Right? So, for a long time, you had gold as kind of the base money, and then for centuries, you had various kind of proto-banking technologies to make the movement of that value separate from having to actually move and verify gold every time. And so what they shared in common was that it always relied on trust. There was, the Hawala system was active for, 1,000 years or so. There's bills of exchange that are written on papyrus. There's bills of exchange written on paper across the Silk Road. Islamic merchants are thought to have brought banking to Europe eventually, to Venice and places throughout Italy. And so you had the proliferation of more complex banking services there. And it's really about allowing the ownership of gold and ownership of underlying money to move faster than gold itself can move. But really, it was the second half of the 1800s that really opened up the speed of transactions because you had the invention of telecommunication systems and you had the laying of the undersea cables across the continents. And so from that point, the separation of transaction speed, which was now the speed of light, was completely removed from the speed of physical money, physical settlement. And so for about a century and a half, we've been in this environment where transactions move at the speed of light. It's very simple to do a transaction. It could be done as simple as Morse code. Now we do it differently, whereas actual underlying settlement, got basically dropped away. And what Bitcoin, I think, represents is kind of the ability to do settlement, final settlement, at that same speed of telecommunications, which prior to 2008, 2009, wasn't really possible. And even the underlying technologies that made that happen didn't come into fruition until the years leading up to that. And so I'll stop there. But essentially, Bitcoin is just kind of this revolutionary new way to think of money, to send money, to operate with money from the root layer rather than just like an overlay.
That's great.
A slightly different perspective, not so historical. Bitcoin launched 14 years ago. It's one of the best, if not the best, performing assets of the last decade. It's highly liquid. And our survey work shows that when individuals enter this space for the first time, Bitcoin's really one of the first tokens that they buy. If you go back to 2018 and you look at the top 20 tokens by market value, only 6 are still in the top 20 today. And Bitcoin's obviously in the top, it's still around 50% of the ecosystem. And I think at this point it's certainly safe to say that Bitcoin's here to stay.
Great. So how has the journey of the Wall Street community been with respect to warming up to the understanding of digital assets and Bitcoin as an asset class? Like from 2017, when it was like no touching Bitcoin, to then let's get to learn more about it and started to gradually, everybody started to question. And now people are looking to adopt. So how has that journey been from research perspective and corporate perspective as you see in your interactions?
Well, I think that what you always see on the buy side, and I was on the buy side for a decade before I came over to the sell side of the business, what you always see is the push and pull between FOMO, fear of missing out on the one hand, and then fear of career risk on the other. And crypto, Bitcoin in particular, is really right on that spectrum, sliding back and forth over time. And so when we saw the big boom of crypto back in 2017, 2018, there began to be a lot of questions about that. In my case, it was really in the context of a company like Square, which was just beginning to integrate Bitcoin into what it was doing. Over time, we have seen that boom and bust cycle continue. 2021, we had clients asking constantly about crypto, where would it fit into their strategies. There was a tremendous amount of interest. 2022 was a rough period along those lines. Frankly, the last number of weeks, we've seen a significant uptick, which correlates with the increase in the price of Bitcoin, I believe. So I think Wall Street is still getting its hands around what Bitcoin is, the role it could play. From a client standpoint, we see an awful lot of interest, not necessarily the follow-through yet. And I think the single biggest concern there is that the regulatory environment remains uncertain, especially of late when you see the SEC cracking down on crypto in general. What we have tried to do, and we just launched our initiation of the space and coverage of MicroStrategy stock this past Thursday. What I was trying to impart is the fact that Bitcoin is separate from the rest of crypto, specifically in the eyes of many of the key regulators, including the SEC. And this really puts it in a different category as far as investability is concerned.
Yeah, so
from Bank of America perspective.
Yes, so from BofA Global Research, Alkesh Shah and I, we launched coverage about 2 years ago, and we put out an 140-page report. That will hopefully be the last 140-page report that we ever write. But we really wanted to take a holistic view of the space and explain, why it has implications across every sector. And since we launched, we've spoken to over 1,000 clients, and hedge funds, asset managers, sovereign wealth funds, family offices, central banks, private equity and venture capital. And so I really think it underscores that whether or not you decide to invest in this technology or leverage it, it's really important that you understand it. Now, when we launched, we took a slightly different view than what it had been done before. So, most analysts were either covering, just Bitcoin, or they were covering Coinbase. But we took a more holistic view. So our view then, which is still our view now, is that blockchain technology and digital assets are part of an emerging tech asset class. And again, this asset class has the potential to transform every industry. And I actually think this is why it's going to be such a great panel. We have 3 very different perspectives from Mark's sector coverage, Lyn's macro, and Bitcoin knowledge, and our higher level view of looking at layer 1s, including Bitcoin, all the way through the layer 3 applications, as well as regulation and private companies.
Yeah, it's great to see that companies like Bank of America are stepping up and publishing research and learning more and spreading the awareness amongst all the institutions. So, Lyn, what do you think? Like, if you can elaborate a little bit more on the Bitcoin versus crypto aspect.
So I think it's been challenging in the sense that for a long time it wasn't even big enough really to be investable by at a Wall Street scale. So almost by necessity, you're kind of late compared to how long the asset's been around, which is inevitable. And then I think another challenge is that because it sits at that blend of computer science and finance. It's a multi-disciplined field, and so it's actually pretty challenging to wrap your head around the first time. You usually have to run into it several times to really start understanding the industry and the technology here. And so, technology people might not understand the finance implications fully, and finance people might not understand the technical differences fully and how to separate the different asset classes. So it's just by extension a more challenging problem than I think that compared to other assets. And so for a while, there was that sense where, the phrase was like blockchain, not Bitcoin, where, if you ask someone, what do you think of this technology? They say, I don't know about Bitcoin, but I think blockchain technology is going to be very useful for a lot of industries. And the funny thing is, fast forward, I mean, outside of finance, you don't really see a lot of it. And I think it's basically becoming more apparent over time that decentralization is actually pretty expensive. There's a number of trade-offs you have to make in order to actually be decentralized. And so what we see generally is that there's been these waves of hype, but so far kind of the key application of this technology is money. So Bitcoin and stablecoins are kind of serving most of the utilitarian use cases so far. And other things are basically changing how trading works, liquidity works, things like that. But a lot of it is really focused within that financial realm. And so I think the importance of Bitcoin that separates it from the others is a couple main things. One is that it doesn't pass the Howey test. It's not a security. There may be others that it's unclear if they're a security or not, but Bitcoin is the most clear at not being a security. So it's got a different regulatory framework basically any way you look at it. And then number two, in part because it's, part of what makes it not a security is that it's so decentralized. The way it was launched, the way it's designed, the limitations that it chose to have. Basically, it chose to be slower, it chose to have certain limitations in order to maximize decentralization. And so it's more of like a protocol, whereas when you look at other assets, there's kind of a spectrum. Some are more centralized than others. Some of them look almost like a company in a sense. Some of them are a little bit in the gray zone, whereas Bitcoin's more firmly in that protocol layer. So it's kind of like building on the internet. It's building on this somewhat more open system.
Great. So that understanding is developing now more, and people are trying to differentiate from not just blockchain and not just crypto and like focus on Bitcoin. So who are the key institutional players who are participating in different ways or are looking to enter either getting direct Bitcoin exposure or some proxy for Bitcoin exposure? What are the institutions that you hear in your conversations who are active in Bitcoin space or looking to enter?
It really spans the gamut. What's interesting is that yes, hedge funds are very much interested in the space, at least on the periphery, but we're seeing some real focus coming from major mutual fund complexes to the extent that you see entire teams that are being stood up focusing just on this area. What's interesting along those lines is that those teams really haven't begun to execute in a wholesale manner yet. They're really beginning to build out the infrastructure that they need in order to do so in the future. Again, one of the constraints there has been concern about the regulatory environment, but there is an understanding that Bitcoin does stand separate from that and is therefore more investable. One of the things that I would point out, as I said earlier, I'm a BlackRock alum, and I found it very interesting to hear just in the last few days that BlackRock is moving away from its traditional portfolio construction recommendation, really what is traditional across the industry, which is 60% equities and 40% fixed income, specifically so they could allow for the introduction of alternative assets. To me, that is a recognition of the fact that digital assets and Bitcoin in particular has a place within portfolios. That, given the fact that BlackRock is the world's largest asset manager, $7 trillion in asset under management. That's really a big shift. We expect other firms in that space to follow suit.
Andrew, what do you see?
Sure. So we can't name our clients that But I think in general, the idea that institutional clients don't have exposure, at least as it's reported in the media, isn't really quite true. So our hedge fund clients have largely implemented volatility and momentum strategies, and they're actually currently working on building long-short portfolios. And on the asset manager side, many of them are building token trading desks. Some of them are even prop trading. So I don't think the question is when institutional clients will add exposure to Bitcoin or digital assets. It's when will they do more with Bitcoin. I'd also point out that last year, even with the correction, institutional interest actually never dimmed, and in fact, it actually accelerated. And quick story is that I was talking with someone at a VC that had invested in FTX, and we're talking a couple days after it collapsed, and I asked him if he was considering unwinding some of his digital asset investments, and he basically laughed. So I think the point is that institutional investors understand the transformative nature of this technology, and Bitcoin's obviously included in that, and they'll continue to build long-short portfolios, token trading desks, and you also see token exchange-traded products, which I think is actually a major driver of Bitcoin demand that doesn't get nearly as much attention as it should.
Yeah, Lyn, any thoughts?
I think they covered it well. I mean, basically, it's because it's a new industry. There's been a number of landmines that institutions have had to navigate when getting into the space. I mean, one of the potential traps was saying, okay, it might be risky to own the coins themselves, so I want to invest in a company that is doing something with that. But then some of them end up being Celsius, FTX, these kind of entities. And so you've actually had like pension funds run into damage by investing in things that are ironically more risky than owning Bitcoin, right? Offshore exchanges, very leveraged types of trading houses. And so in some ways, basically the landmine is letting the complex, it feels safer because it's more in line with the security and the legal structure that they're used to, but it actually exposed them to a lot of risk. And so I think that over time, just as these waves come and go, I think institutions are getting more sophisticated in how they enter the space and what they choose to invest in.
Great. So I'm sure our audience would be interested to learn about, with all things going on in the banking sector currently and a lot of turmoil, how is the relationship between the traditional finance and the banking world is evolving with relation to Bitcoin firms, and how does that impact the adoption or use case for Bitcoin? So Lyn, would you like to unpack the current banking situation, the crisis going on?
Sure. I mean, so here in the United States, we're getting a small taste of what people throughout the world experience on a more regular basis. We've had the fortune of being somewhat insulated from it with one of the safer banking systems out there, stable currency compared to the long tail of other currencies. Whereas if for the majority of the world population that lives in developing countries, they're more prone to experiencing either extraordinarily high inflation or problems with their banking sector. And so it's no surprise when you look at the crypto adoption index, like the Chainalysis crypto adoption index, something like 18 out of the top 20 countries by adoption metrics are developing countries. Because you don't have to you don't have to sell someone there on the idea of why this technology might be useful to them. Whereas if you live in a very stable environment, it's much easier to ask the question, well, why do I need Bitcoin? Why is any of this other things interesting me? It's very easy for me to make payments. We just had the presentation from Cash App. I mean, it's a super easy app to use, and you say, okay, if I have this, why do I need Bitcoin? Whereas, in jurisdictions where it's just not as stable, it's easier to sell the idea. And so here in the United States, we basically have had this duration problem in the banking sector. So back in 2008, it was a credit crisis. Basically, banks made loans. Those loans, a lot of them defaulted. They were, very very aggressive type of lending that blew up. Whereas in here, in some ways, we have the opposite problem. Banks invested in very safe assets, but they did so at very, very high prices, meaning very low yields. And so, we've had an unusually big whipsaw in monetary policy. So we went from, zero rates, quantitative easing, tons of new, reserve creation, do, okay, now it's inflationary, and now we're going to hike rates very quickly. And when you take a very indebted system and you move rates from 0 to 5%, that's basically the fastest basis point increase in a year since the 70s. And it's the fastest in percentage terms ever, because back in the 70s, they didn't start from such a low base. They started from a higher base. And so this has been a huge shock to the financial system. And I think people are, they took for granted what a lot of the world doesn't really take for granted, which is that banks are risky, that there is risk there, especially if you're above certain, insurance limits. Basically, you're making you're lending to the bank to invest in a variety of assets, and most of us don't take the time to study the assets of the banks we operate in. Many of them are not public, so we can't even do so if we wanted to. And so we're kind of seeing firsthand some of the risks that are just common throughout the world, and the narrative of Bitcoin and basically being able to self-custody your own assets, having assets that can't be diluted, having assets that are not someone else's liability, I think are coming more to the fore, and more, the narrative is obviously strengthened by some of these issues.
And what do you see? So Mark, in your experience, you worked with the US firm before, and you're working with a European firm. Like, how is the landscape different, and how is the relationship with Bitcoin there?
Well, I think one of the things that we see is that Europe has embraced digital assets and Bitcoin in a way that the US has not yet in a full manner. And when I say the US, I mean the US government and the SEC in particular. The fact that the SEC has not yet approved a Bitcoin ETF is fairly astounding. If you look at, Andrew mentioned exchange-traded products, which are prevalent throughout Europe and Brazil and Canada, they're available. It's just not available here. If I could say one thing with regard to the what's going on in the banking sector, I think we also have to look at what's going on globally in the central banking sector, because one of the things that is driving a greater appreciation of alternative assets, I believe, and Bitcoin in particular, is that the US dollar has come into question, as has the US Federal Reserve. And what we have seen is that the percentage of global central bank reserves held in US dollars has declined from about 70% at the end of the 1970s to about 58% at the end of last year. That relationship really accelerated in the past 12 months. And that, which is known as de-dollarization, is really causing a reevaluation of fiat currencies, compounded by what's going on in the US regional banking sector in particular, and the perception that the Federal Reserve has, to a large extent, been a bit asleep at the wheel as it pertained to that. So I think that what you have is just a confluence of macro events which are helping to put a spotlight on Bitcoin, as has the upcoming Bitcoin halving, which I'm sure we'll talk about.
Sure. So I think the banking turmoil, it certainly did drive demand from retail. But when we look at our surveys, the two main reasons that people add Bitcoin is for appreciation and diversification. So I don't necessarily think that a tail risk like a banking collapse narrative is necessarily going to drive mass adoption. But when we think about the institutional side, you had a lot of macro hedge funds adding gold last year, and especially this year. But a lot of them have actually topped out their allocations. So we have heard and seen that some of these macro hedge funds are actually also adding Bitcoin, which is interesting and something that could continue.
Yeah. So people are also getting aware on how a true bearer asset like Bitcoin can help them provide protection against holding the fiat currencies. So do you see anything on that front on how are bigger institutions thinking about it, and how does that impact their thinking?
Well, so one of them is, I think, the correlation with interest rates. So for example, one of the things that the banking system does is it potentially changes forward expectations of how much the Fed will be able to tighten, at least within a certain time period. And so, if you step back a second and you think, okay, with this much debt in the system, with these large deficits, are they able to get to a period of positive real rates and then hold that for a long period of time? And if you have that expectation, then assets like gold or Bitcoin are perhaps less useful to you. I mean, the speed and programmability of Bitcoin is still interesting, but maybe from a a safety perspective, you say, well, I'm fine with the banking system, I'm fine with treasuries, I think they're going to maintain purchasing power. On the other hand, if you kind of look in history, generally when you get sovereign debt, and it's not just the United States, it's across Europe, it's across Japan, when you reach these high levels of sovereign debt, like well over 100%, usually those bonds and that cash does not make a very good forward savings instrument on a real basis. Now that can have a big spectrum for how that turns out. Obviously on the extreme end, you can get sharp, very, very sharp currency devaluation, hyperinflation in some cases. In other cases, you just have this prolonged period of financial repression, generally rates below the inflation rate. Sometimes they go above the rate, but sometimes they come back down, and they spend often more than half their time kind of below that level. And so right now, the Federal Reserve's kind of in this trade-off of trying to get, as of now, they've kind of gotten back to positive real rates on a trailing basis. But it's come at the cost of financial instability. And so you're kind of going back and forth between where do you want to hold your money, and then the money itself, is it going to hold value over, say, a 10 or 20-year period? It could certainly be very useful for periods of time, but it's like, is it something you want to store your energy in, or do you want to go elsewhere? Do you want to go to equities? Do you want to go to commodities? Do you want to go to an asset like Bitcoin? And so I think that's one of the questions that people are looking at. And then when we tie it into the potential de-dollarization, the somewhat diversification of reserve practices and payment systems around the world, one way to look at this is that money is essentially a ledger. And so for the past 50 plus years, the world's been really reliant on the Federal Reserve as kind of the ledger for the whole world. There's all these other central banks, but they themselves tie into the Federal Reserve, and they tie into the US Treasury system by holding assets, connecting themselves to that ledger. And as we see kind of islands form, or as we see kind of a multipolar world in terms of all these different ledgers kind of competing with each other, an open, distributed, global ledger like Bitcoin, I think, becomes pretty interesting.
It's just amazing. Like in the US, people never thought that the money keeping in the bank account could be an issue, and we need to worry about it. But with all things going on, I mean, people are starting to think about it, and it's just increasing awareness about, we say about the FDIC insurance that's covered only up to a certain limit and not covered beyond that. One of the banks, with respect to the Silicon Valley, the numbers were like more than 90% of the funds weren't insured, and then FDIC also covers like a small portion. So that's leading to the institutions to think about different avenues and like how do they diversify, or like how do they protect themselves. So how do you think about Bitcoin playing as a role in the institution portfolios and portfolios of the money managers?
I think if you look across the spectrum of institutional investors, many of these are unable to buy Bitcoin outright, and so they're looking for alternative means of gaining that exposure. Unfortunately, in the US, again, there is no Bitcoin ETF to deploy. So in Europe, it's different with the ETPs there, but they have to look at alternatives. And unfortunately, some of the alternatives are simply inefficient. One of the biggest ones is the Grayscale Bitcoin Trust, GBTC, which is currently trading at about a 40% discount to its net asset value. And you have to pay a 2% fee per annum in order to have the benefit of investing in that. You do have newer alternatives, such as the ProShares Bitcoin Futures product, ticker BITO. Bitcoin futures are not necessarily the most efficient way of trading in Bitcoin. When they first came out, I think we went hoarse telling clients not to look at futures as being a direct proxy for spot Bitcoin, because you can get yourself in a lot of trouble. And frankly, as we said in our initiation report of MicroStrategy last week, we see MicroStrategy as being, MicroStrategy stock as being a means through which investors, institutional investors who don't have a mandate that allows them to buy Bitcoin directly, can get that kind of exposure. But I think there's a lot of innovation that's going on in the space. And the fact that Bitcoin, in our view, is likely to, again, be separate from other cryptocurrencies, particularly in the US, is going to draw more attention to it, which inevitably draws more innovation, more investment, and the like, and ultimately more investment from institutional investors.
So I would like to follow up on that point. Like, how do you think, in your research perspective, how is MicroStrategy a more efficient way to get Bitcoin exposure?
A couple of different ways. As I mentioned, you've got other instruments that are imperfect in terms of expressing that view, not only a discount to NAV, which is problematic, but also you have to pay a 2% fee for the privilege of buying into those shares. The fact that MicroStrategy has a unique business model where it can leverage its balance sheet as a means of bringing on the proceeds that enable it to buy Bitcoins makes it unique. The fact that its business intelligence software business is generating free cash flow, and a portion of that beyond working capital needs is being used to buy additional Bitcoins is also very unique. The fact that the company has an ATM facility that enables it to issue equity, use the proceeds from those issuances to buy Bitcoin is another differentiator. So I think from a structural standpoint, MicroStrategy does stand out within the space.
Lyn, you also look at the stock, so.
Well, basically, it's that kind of conflict between technology and regulation. So, basically, the spot ETF topic has been around for a while. That other countries have spot ETFs. They work perfectly well. The United States has not allowed one yet, and so we have all these other types of vehicles. GBTC has been a particularly imperfect, to say the least, vehicle for getting exposure. And so, I think we've covered the number of options, but basically when you go to futures, there's always a risk that it can deviate from the price of the underlying. There are a couple different ways that can happen. If you look at ETFs that track commodities, for example, some of them follow pretty closely. Other ones have had a history of underperforming the commodity itself, and so you end up having two types of risk. And then with other funds, whether it's GBTC or when you have equities like MicroStrategy, you can have a situation where the value of that asset can fluctuate up or down compared to maybe the underlying NAV that it's really worth. And so that's something that the investor has to monitor and can make use of when appropriate. And so there are a number of, it's good to see that there's far more diversification, far more options that institutions and retail investors have. But they're still somewhat limited. I do think MicroStrategy's one of the cleaner ways to access it at this point because you have that positive carry. And so for people that can, I think owning Bitcoin is directly is kind of the best way to go. You get to make use of the actual underlying asset. You get to experiment with it. You can, try the Lightning Network. You can bring it on to some of these ecosystems. You can use it on Nostr, the open source social media protocol that was mentioned in the keynote briefly. There are a lot of things you can do with the underlying asset, and these closed ways of accessing it are somewhat limited. But the way that regulations work, the way we need to hold it in many cases makes them very necessary. And so it's good that they're increasingly available in a number of shapes and a number of kind of different packages.
So Andrew, when you talk to other corporates and institutions, what do you typically encounter as the concerns or challenges that companies face when they present any Bitcoin exposure to their risk committees? So what do you hear in your conversations?
Sure. So I think the biggest headwind here is really just lack of regulatory clarity. And then there are also a lot more considerations that you have to take into account. For example, custody, which tokens you want to hold, which tokens you want to sell, how long you want to hold them, and different levels of risk that you need to take into account. So I think your question was around Treasury. I don't think that right now a lot of treasurers are considering the benefits of adding Bitcoin to the balance sheet just because of a lack of regulation. But I would say that we do talk to a lot of treasurers, especially on the corporate side, and I think that part of the way that treasurers begin to touch Bitcoin and digital assets more broadly is simply that they will begin to accept payments. And when you begin to accept payments and tokens, the same considerations I was mentioning before, you have to consider again. And I think part of it is that also, Bitcoin's been around for 14 years, but it's really easy to forget that many of the blockchains and applications in this space are really less than 3 years old. So, we may have been following this for a long time, but a lot of this just takes education, and education takes time. And that's really where we spend a lot of our energy speaking with clients, really just educating them on this space.
Yeah, certainly there's a big educational component here. And on the topic of education, MicroStrategy is kind of leading the way and being the first runner in the space and figuring out everything is like a new thing, and there are no precedents. And so what we have done is we have open sourced our playbook on corporate treasury adoption from different perspectives, from like legal, from accounting, from tax, and how do even companies present it to their board, and how do they get it approved. So all those materials are available publicly on our website, hope.com. It's very easy to remember. Bitcoin is hope. So I recommend people to have a look at that and learn more about it and keep learning. So, yep.
Shirish, if I can just say one thing on this last topic. If you look at MicroStrategy's earnings, and the company just reported earnings a couple of days ago, what we have seen in the company's statements now, since it adopted its Bitcoin acquisition strategy back in August of 2020, are some pretty significant impairment charges that relate to its holding of Bitcoin on its balance sheet. Now, these impairment charges stem from a standard that's been in place from the Financial Accounting Standards Boards of the FASB with regard to the treatment of digital assets on balance sheets. They're treated as intangible assets. What this means is that when a company holds Bitcoin on its balance sheet and the price of Bitcoin declines during a particular period, the company has to take an impairment charge. If the price of Bitcoin appreciates after that, company gets no benefit from an accounting standpoint. And so this is a hostile treatment of Bitcoin on balance sheets. I guess the good news for the space and for the potential adoption of Bitcoin on corporate treasuries going forward is that just in March, FASB has put forth some amendments to that policy. Those amendments are now in a comment period that's going to extend for a few more weeks. But we are looking at the very real potential that we could see a change where Bitcoin, instead of being treated in this manner, is basically mark to market on the books of corporations, treated at fair value, which could be a significant catalyst for other corporations to adopt Bitcoin as a reserve asset in their treasuries.
Yeah, a couple of things I notice with companies I work with is that there's been quite a lot of adoption among smaller private companies, whereas obviously there's more frictions for a large and publicly traded company. And there's two main components of it. The one is the accounting treatment, which you just covered, because not only you might know the value of those underlying assets, but you have to communicate the value of those assets to shareholders, which is more complex. And then number two is basically the problem of career risk. If you have a company where the founder's still running it, basically there's fewer people that need to make key decisions. They're obviously able to move faster. They're able to make a high conviction decision. Whereas when you have very distributed entities, where the people running it are not the founders, it's more about basically staying with the company, thinking in the intermediate term. And that's one of the challenges of some of the larger entities. And so there's obviously some exceptions out there where you have very strong leadership and you're able to make those high conviction decisions. But it is kind of a friction point that we see, not just in large corporations, but also pensions, endowments, sovereign wealth funds, kind of these very, very large entities. It's often a good thing that there's more safeguards and more kind of key decision makers that have to make a move, but it's inevitably a slower process compared to smaller, more nimble entities.
In my experience, a lot of people like to touch and feel things, and Bitcoin looks like it was intangible, and they don't get full understanding of it until they dive deeper. But when people start to see Lightning adoption and Bitcoin being used as a means of payment, that makes it very real for people. So how do you see, how is Lightning going to play a role, and how is it being perceived by different institutions? Lyn?
One thing I'd recommend is even if your entity doesn't own Bitcoin yet or hasn't worked with Bitcoin, at a personal level, it's worth experimenting with. It's worth researching it, understanding how it works, and actually trying it, because that's what addresses that intangible aspect. If you interact with a mobile wallet or interact with a hardware wallet, if you send it to someone else, if you receive it, if you use it in an application, you earn it from playing a game, or you tip someone over Nostr with it, it can kind of open your eyes to the power of the technology. It's, a lot of analysts, when they look at it, they just see it as a price line on a screen, and it seems very intangible. And they might not be able to differentiate at a technical level what makes Bitcoin different than Dogecoin, for example. Whereas when you actually roll your sleeves up and dive into it a little bit, I think that's what informs people. And usually what I see at institutions is usually people in the ranks that have done that, on their personal life, that they have become familiar with the technology, and so they become kind of laying the seeds within their organization for why the organization might want to start looking at it, how this could be relevant to the organization rather than just themselves. So I think that's one thing really worth doing, is actually experimenting with the technology itself and seeing firsthand. You don't want to be kind of left behind as these things evolve over time, and you're always looking at it just from a price standpoint rather than actually an interactive standpoint, because that can show you what works, what doesn't, what makes this powerful. And a lot of the question I still get from people is, why does Bitcoin have any value? Why is something so intangible valuable? And a lot of that is addressed by stepping back and saying, if you look at the world, right? Again, in the United States, we're very privileged. We've been very safe. But there's a lot of people in the world that have to, cross borders, send payments across borders. There's 180 different fiat currencies roughly in the world. The long tail of those lose value generally very rapidly. You almost have this kind of like international barter system where it works like money in their own jurisdiction, but when they want to send or receive money to another jurisdiction, it goes through all these different frictions, and they don't really have a lot of alternatives. A lot of them, people in these countries turn to dollars, but then it becomes, where do you store the dollars? Do you hold physical cash? Do you dare stick it in the local banking system where if there's a dollar shortage, it could be taken from you? There's all sorts of challenges. And so in those environments, basically, Bitcoin becomes very interesting, and there's more of an incentive to, I think, learn and understand how it works and see why it's powerful. And when you think, what can you bring with you globally, right? A lot of assets are custodied by an institution. You can't bring a lot of gold through an airport. You can't bring a lot of cash through an airport, whereas Bitcoin represents this asset that is more mobile than anything we've experienced before. It's basically ownership of money in a decentralized cloud. And it's open, it's permissionless, it connects to so many things, and it's really hard to get appreciation of that if you haven't actually tried with it. It's powerful to feel that, okay, I've downloaded a mobile wallet, I've received Bitcoin, and you see how, oh, wow, that was fast, and there's nothing else to do. It's final settled already, and then you can send it to someone else, and you start to see firsthand why that's actually innovative, and it's not just a fintech layer over existing money. It's actually kind of a new form of money at the root layer, which is really powerful.
That's a great point on experimenting, because personally I was into Bitcoin since 2017, diving deeper and deeper and learning. But it wasn't until like 2022 when things started to accelerate too much in the space, and I started to experiment more with self-custody, with Lightning. And when you actually do it and make others to do it and see the reaction, I mean, that's like the real game changer. I mean, that's where things start to feel very real. So on Lightning, yes?
Sure. So when you look at cross-border payments, cross-border payments can take 7 days to settle. They generally involve about 5 correspondent banks, and they're very costly. And so when we think about the Lightning Network, I can say that the Lightning Network has never come up on a call with institutional investors, hedge funds, asset managers. But when we think about adding Bitcoin exposure for appreciation, in order to drive demand for Bitcoin, and again, this is a supply-demand commodity where supply is fixed and demand is variable. And so in order to drive demand, you really need a use case. And the ability to send value really anywhere in the world at the time it takes to send an email, certainly is a use case which we would expect to drive demand and therefore price. And institutions that are adding Bitcoin, they care about price appreciation or diversification, but in this case, appreciation.
Yeah.
Yeah, and when I have written about the Lightning Network in the past, and particularly when I've interviewed Elizabeth Stark, the head of Lightning Labs, to talk about the implications of its growth and publish those reports, I have gotten calls from investors who were in any of the publicly traded money transfer companies, the ones we all know. And there are a lot more of them now because the online ones are now in the public equity space as well. And those calls were very concerned because when those investors looked at the economics of Lightning Network in terms of remittances, and actually we just heard about this in the context of Cash App a little while ago, it's scary to those who are currently invested in the incumbents because they recognize that as the Lightning Network adds scale, it will be a potential significant disruptor of all of those companies that they're looking at.
No, it's so amazing that Lightning Network, we are just scratching the surface at the moment, and institutions are just beginning to get there. So I don't think there's enough appreciation for the gravity of what happens when the institutions and corporate start to jump with both of their feet into the water rather than just dipping their toes into Bitcoin and Lightning. So what do you think happens to Bitcoin adoption and Bitcoin price? And Andrew, I would like to hear Bank of America's views on this.
Sure. So, our view is that, as Lyn was pointing to before, Bitcoin is a supply-demand commodity. Supply is, of course, fixed, and demand is variable. And, our view is that over time, digital asset adoption is accelerating, and it continues to accelerate. And, as institutional investors enter this space, we would expect them to, Bitcoin is obviously a very key part of this ecosystem. You can't really talk about the ecosystem without talking about Bitcoin. And, our view is, we don't have a price objective, but our view is that over time, the math says that, increase in demand should drive the price higher.
Lyn?
What I generally find, there's a lot of research over time about how important the halvings are, either for magnitude or timing. And what I generally find in my research is that they're very important for magnitude. They help set a higher floor each time, assuming demand stays reasonably robust. Whereas timing is more liquidity dependent, right? So there's various measures of global liquidity that you can do. You can look at, for example, global broad money supply in dollar terms, which is, it's either influenced by how rapid new money units are being created or how strong the dollar is relative to those other currencies, because it's kind of the unit account for global trade. And so when you see these kind of year-over-year liquidity measures, Bitcoin's historically been very correlated with them. So from a macro trading perspective, that's really what drives price in any sort of multi-month basis. Whereas what the halving does is that, there's a very strong base of Bitcoin buyers. Many of them dollar cost average in on a monthly, weekly, even daily basis. They're dollar cost averaging in. They've poured a lot of research into this asset. They They want to put a percentage of their paycheck in, things like that. And so there's kind of like this floor of very high conviction buyers. And what the halving does is it keeps reducing how much new supply comes to market that has to be absorbed. And so when you get to a point where there's more conviction buyers than there is that new supply, the price has to go up, assuming that there's no sharp reduction in demand, which occasionally happens, but not among that kind of high conviction crowd. And apart from price, I think one thing really worth exploring is the idea of micropayments, which is what Lightning can open up, and what some of these other layers on top of Bitcoin can open up. Because if you ever thought and asked yourself, like, why can't I pay 25 cents for something over the internet, or 10 cents for something over the internet? Why can't I pay a quarter to read an article? And it's often because the payment systems themselves are limited, right? There's often like a base amount of back-end handshaking that has to be done in order to make that transaction possible, which is, because of that overhead cost, there's kind of a minimal fee in order to do that type of payment, whereas an open source payment system like Lightning allows for these micropayments. And what any powerful technology does is it doesn't just change existing markets, it creates new markets, right? So it doesn't just go back and change how we interact with things now, it opens up things that we didn't think we would be doing. And so, for example, with AI and machine-to-machine payments, for example, micropayments, having this type of infrastructure opens up entirely new product ideas, entirely new ways of interacting peer-to-peer that just weren't possible in this kind of legacy system that requires a lot of handshaking, especially when you go international. And so I think both from a price standpoint, as obviously more institutions get involved, I think I'm personally long-term bullish on the asset, but it's also about how it can change how we interact with applications, how we interact with each other online.
Mark?
Yeah, of course, we picked up coverage of MicroStrategy, and if you're going to cover MicroStrategy, you have to have at least an assumption with regard to the price of Bitcoin going forward. And so we did establish an assumption based on the supply and demand of Bitcoin, which in our case, we are estimating that Bitcoin will reach 44,250 by the end of April 2024. Why did we cut things off there? Because there is a pretty significant potential catalyst in the form of the Bitcoin halving. And looking back at the previous Bitcoin halvings, when the reward to Bitcoin miners for each block they mine was cut in half in 2012, 2016, 2020, there was a very significant run up in the price of Bitcoin ahead of that event, and that continued after that event. And so when I ran through all of the reasons why we believe that Bitcoin is likely to appreciate in the coming months, we laid out all of the other macroeconomic reasons that we've talked about, but the one thing that really caught people's attention, whether it was internally at Berenberg or with our clients, was the fact that the halving is out there, and we actually have that historical precedent of the price of Bitcoin appreciating the way that it has, both before and after it. So that is the context through which we are viewing Bitcoin currently.
So I get this question, like, isn't halving priced in already? And it's demand supply driven, but like, any thoughts, Lyn, over there?
Basically, I would repeat what I said before. And I've had these discussions with a bunch of other analysts. Is how, to what extent is the halving relevant for price? How much is it priced in already? And generally, what I find is that what's challenging is that the halving is these 4-year cycles. Whereas if you look at global liquidity, it's generally been acting at roughly 3-year cycles. And so you can get this you get these price rises, and you're like, was this because of the halving, or is this because of liquidity? And generally what I find is that liquidity is more closely correlated with the precise bull markets of Bitcoin. But I think that what makes the halving so relevant is that, especially in bear markets, it really helps set the higher floor, because it basically reduces how much new supply is coming to the market. And so when you get a steadily growing amount of kind of persistent demand, people dollar cost averaging in, people willing to aggressively buy dips that happen, it only takes a pretty small base of that as you get less and less supply coming to market. And so if the price doubles, but the new supply gets cut in half, it's still the same amount of new buying pressure that has to happen. And so when you add, if you have buying pressure double, and you have new supply coming to market get cut in half, those are not a very aggressive assumptions. That the halving is already, preordained, and generally, Bitcoin has had this kind of steadily increase in demand over time. That's more cyclical. It often follows liquidity. But when you have that kind of steady march beat higher of demand, or even just steady demand, and then you have that reduction in new supply over time, it's very powerful for the price, obviously. And one question I get is, why hasn't Bitcoin adoption been faster? When you look at some technologies, electricity or TVs and things like that, you have these kind of like very smooth adoption curves, whereas Bitcoin's been very volatile. People get into it and they get out of it. Whereas, for example, in new technologies, people often don't go back. They don't get a smartphone and then go back to a flip phone. They don't get electricity and decide they don't want electricity anymore. When you look at all these things over time. But I think what makes it different is that because it's monetary, it's inherently more volatile. Because when people adopt a new technology, they don't leverage that new technology. Whereas with Bitcoin, people leverage it, they get over-enthused about it, and that necessitates a correction, which ends up being further exacerbated by that leverage, cleans out, people lose interest, they think it's dead, and so it goes through these kind of repeated cycles. And so I think what we're on is like this longer, more cyclical grind of just higher and higher adoption. And the halvings play a key role in kind of raising the floor each time.
I think that's a great explanation for a closing. And there are hundreds of trillions of dollars of assets sitting on the sidelines from these institutions. And corporates entered. It was new. And then the institutions, like broader institutional adoption, hundreds of trillions are looking to enter into Bitcoin or get some exposure. And then nation states are also following. So we are all excited about what happens in the coming years. But one common theme that comes out from the panel is that Bitcoin is very real, the adoption is real, and it will continue to get adopted more and more, and there's more appreciation. So very excited to see what happens next. And thank you so much for all the insights that you provided and a great discussion. And thank you all for joining us.
Thank you.
Thank you.
Yeah.